Cast your minds back to February 2020. Unemployment was low, the stock market at an all-time high. You could buy all the rice, toilet paper and pasta that you could ever want. But since then, the Aussie share market, measured by the ASX 200, has fallen 30%. The bulk of that loss has come from March, as the market's lost 24%. The hardest hit sectors with the most selling: energy, property, financials and consumer discretionary stocks, while the more conservative defensive sectors have outperformed and seen the most buying, including staples, utilities, healthcare and miners. And this is typically what we see in what's called a risk-off environment, and this is likely to play out for some time as investors seek out those more secure businesses who have a history of paying dividends. Remembering defensive sectors have also outperformed in periods of low economic growth in the past, and that's likely to continue because we all need their services regardless of what's going on. And that explains why Metcash, the owner of IGA, is the best performer this month, up 25%, followed by Fisher & Paykel, up 11%, as their ventilators are being used to help COVID-19 patients. They've seen a strong rise in sales demand and upgraded their production and earnings forecasts. On the other side, some of the worst performing stocks have been the radio and regional TV business, Southern Cross Media, down 75%, followed by outdoor advertising company oOh!media, down 73%, as less businesses are inclined to fork out funds for marketing, media and sponsorship. But let's just pause. Remember, when it comes to the broader market, we have to remember, looking at the past, markets have always recovered over the long term. And looking at the last bear market in 2008, we lost about 50% from late 2007 to early 2009. And if you sold down in that time, turning a paper loss into an actual loss, you could have also missed out on the rebound of 59% over the next year or so. We know coronavirus will be taxing on global GDP and company profits this year, but beyond that, many research houses and analytical firms agree coronavirus won't have a lasting effect. This bear market is also different to the GFC. Reserve banks and politicians have learned from the past, reacting quickly by dropping interest rates and boosting fiscal stimulus. On top of that, the Aussie corporate banks are helping those with mortgages and helping corporates with loans. And this is also why Morningstar says once we do have a treatment in the market and once infections have stopped, markets will rebound. Global economic growth too is likely to be above trend next year and right through to 2023. Let's have a look at strategy and asset allocation now. Aside from thinking or screening more heavily on those companies that will stand tall in 2020, the defensive sectors, it's important to actually look under the hood and see how much debt these companies are carrying. If you feel that they do have high debt, but they are well managed enough to ride out the storm, some stocks in this category, according to Citi, that you could look at include Ramsay Healthcare, which is likely to partner with the government. Another one is Charter Hall CHC. It has 45% retail exposure in supermarkets and service centres and hardware. Brambles, the pallet business, has about 80% exposure to food and beverage. Another company is the packaging business Amcor. It has 80% in food, beverage, healthcare, and also rising demand in packaging safety. Now, you also might like to consider companies who have repeatable cash flows, quality earnings, and good dividend growth. On BuilDirect's website, I use the Strategy Builder tool, which is powered by Trading Central, to search for companies in these categories, not considering anything else though. I screened for stocks that have low debt to equity ratio of no more than 0.4%. I then looked at how much their share costs are versus cash flow being generated by the company. That's price over cash flow. Then I looked at those that pay a dividend and have a history of paying dividends. I then looked at gross margin, which is measured by revenue less costs. And then lastly, I looked at companies that have had EPS growth for the last 5 years. 9 companies met that criteria, including property groups like Mirvac and Goodman, MGR, GMG. Brickmaker, Brickworks, BKW also made the list, along with investment management firm Washington H. Soul Patts, Sol, and ASX. So in closing, considering your asset allocation, consider dialing up those that have secure defensive risk profiles and look at those companies that can pay regular annuity style income. Why not check out BuilderX's strategy builder site so that you can hone in on those companies that you like. Also, remembering we can't pick the bottom. We don't know when the bottom will be unless we look in our revision mirror. So in times like these, I'm taking advantage of discounted quality stocks. I'm investing into the market on a regular basis, and this is known as dollar cost averaging. And this means if the market falls further, I won't kick myself. But once the market has recovered, I'll stand tall, as I would have made more money as I regularly bought in when prices were lower and much cheaper. And that's it for me for now. Thank you so much for bearing with me. Any questions, comments or feedback, please reach out. Take care and stay safe.